Hello everyone, welcome back to another stock market investor video. Today I want to have a look at some Reddit pages, some books, other resources that have helped me investing and I hope can help you investing. So when I first started I didn't know about all these Reddit pages and a lot of these books I was just getting started with, but I think if you know these from the start you'll get a head start, and I would advise reading some of these books before you even start investing just to give yourself a good foundation of knowledge. So here's something I found posted by Shane Monksburn, sorry if I say his name wrong, but it's a Warren Buffett value investing cheat sheet that he's compiled. I think it took him quite a while to compile this, but he says here that all of the stats here are derived from Buffett's advice over the years through shareholder letters and other sources. And here's just the sort of the numbers and the figures you want to be going for if you're trying to emulate Buffett's style. So here you can see it has debt to equity ratio, which means you don't have over the 0.5 means you don't have over the value of the company in debt. It is half the value of the company's debt. The price to book ratio, so the price to book isn't over 1.5 times the value, so over 50% more expensive than the actual prices. S&P rating of BB, and a PE ratio, price to earnings ratio of less than 15. So the price of the stock is covered by earnings less than 15 times. And it also has a reasonable margin of safety. And I've got a stock for us to look at in a second that I can explain more of this, what this reasonable margin of safety is, and the intrinsic value. I'll explain that a little bit later. But the moat, that's obviously quite simple. There's a higher barrier to entry for the company you're investing in, prevents it from being overturned by a competitor, for example. So it makes it hard. So someone even like Google. So Google, you could make a new search engine, but because of all of Google's features and their subsidiaries all combined, so YouTube, Google, Gmail, all of that is so intertwined on Google Chrome. So many people use these services, it would be very, very difficult for a newcomer to disrupt this. Even Microsoft couldn't do it with Bing. Bing is actually, I think Bing's actually quite a good search engine, but I still use Google just because Google it's become a verb now. So you could consider that a moat of sorts, and another moat of sorts would be something that's too expensive to replicate. So he also wants a return on equity of more than 8% and a return of assets of more than 6%. And obviously you want stable growth. That should be a common one. That should be a sort of common sense, is stable growth and great free cash revenue. So I'll leave a link to this in the description for you to have a bit of a look over, but it is very interesting. You see some of the other stuff. He's also posted a ultimate investing cheat sheet of his own, which is much more thorough than this if you want to have a look at it, which I think this guy here, Shane Monksburn, again, sorry if I'm saying his name wrong, but he's posted some great stuff on Reddit. And also the R investing, there's also an R investing for the UK, which is quite interesting because on this R investing page they don't do too much talking about the UK. It's mainly US focused equities, which is fine, but there is a UK specific one. So next I want to have a look at some books that I think would be worth reading for all of you if you haven't already. So obviously a classic is The Intelligent Investor. Everybody has to read this one. I've read this. It says here 2003, but it's actually published in 1949. And this book contains all of the sort of statistics that have come from the previous slide I just showed you of Warren Buffett's cheat sheet. This is where Warren Buffett learned a lot of those things. He worked with Benjamin Graham. Benjamin Graham was his tutor, I believe, at a college. I think it was Columbia University. Warren Buffett learnt from Benjamin Graham, who was the lecturer at the time. And Benjamin Graham has coined sort of value investing, and then Warren Buffett proved it worked, really. So this is a book that is fantastic. It's quite heavy reading, so I'm not sure if it would be recommended for your very first investing book, possibly an investing mindset one first, because there is a lot of graphs, there is a lot of actual figures, which is great, but you need to have some sort of foundation first. So definitely get to this book at some point though before you start investing fully. It has a lot of key information in it that could really help you. So the next thing I want to look at is a book by Peter Lynch, and this is called One Up on Wall Street. Peter Lynch is a fund manager. Peter Lynch has a few key things that he tries to do when he buys stocks, and he has returned an average of 29% year over year, and that's how he grew his fund an unbelievable amount. So this is another book that I would recommend reading, and Peter Lynch talks about how individual investors actually have small one-ups on Wall Street, and that's obviously hence the title. He talks about how you're more liquid, you can move in and out of positions easier, you don't have to spend time explaining to investors why you've made positions. Sort of if you're a hedge fund manager, you have to explain why you've entered and why you've exited certain positions. You don't have to do that as an individual investor. There's a few quite important key differences between investing as an individual rather than investing in a hedge fund. So obviously everyone always asks is why could an individual investor be a hedge fund which has hundreds of analysts sometimes from the top Ivy League schools in the world, such as Oxford, Harvard, Columbia, Cornell, all those sorts of schools. How could you as an individual beat Wall Street, and what's the point when people do this for a living when you could just give them your money? Well, in this book he explains why, and why that is sometimes a better idea. So yeah, I'd read this one as well. And a few others I'd recommend are just a Robert Kiyosaki book, The Rich Dad Poor Dad. It seems like a cliche now, but that one actually does help with the mindset quite a bit. So if you just understand the mindset, it's a bit more real estate-y, that book, but he has includes a few things about stocks in there. But that one is just sort of getting in the mindset of making money, keeping money, investing money, all those sorts of things. That is a great mindset book, I think. So now let's have a look. I've promised another look at my portfolio, and let's have a look at this. It's not pretty viewing at the moment. Here we go. You can see at the top my Hargreaves Lansdown, my stocks and shares ISA, which has my only one position in it currently, because I've sold off the other positions, which are now sat in cash of £1,322. But RBS is down 6.04% currently. And I think this is almost an unfair share price for RBS. That's why I'm happy holding it. I was up 20% earlier this year with this same position. I didn't sell, I held, and I'm still happy to hold now because they currently trade at a 22% discount to their net tangible asset value. So this is what I'm talking about with the margin of safety. This is, remember on the Warren Buffett cheat sheet, he wanted a reasonable margin of safety. Well, the asset value of RBS is 286p per share, and they're trading at 217p per share, which is quite a fair, reasonable margin of safety. Also, RBS offers a over 6% dividend yield at this current price, which is obviously fantastic. They've got rising return on equity. It rose to 4.8% compared to 2.2% a year earlier. They want to target 12% return on equity, which would be great, but obviously 2.2% to 4.8% is still good. Their dividend is safe. It is covered 1.9 times by earnings. The bank has a really strong balance sheet. It passes the Bank of England rigor tests every single time it goes through. I'm still happy holding this one. I've been paid the dividend from it, which obviously negates a lot of that loss. It's frustrating to see it down because I was up 20% earlier this year, but again, I still believe in the stock. I believe in the margin of safety that it has. The dividend yield is great, and they're growing profits. Mainly, they're growing profits. There obviously are some underlying issues, such as the Brexit economic factors are yet to be seen, really, as we're still in the European Union. Make of that what you will. But also with Ross McEwan, the CEO, chief executive, has resigned, and they haven't appointed a replacement yet, and that could be a slow process. But Ross McEwan has turned the bank around massively, and he wanted to get the bank back to a place where it was paying a dividend, making a profit again, and he's done that. So I do see why he's leaving, but he's got the bank on some really sure footing. I like a lot of the stuff he's done as well with reducing credit card fees for some people, and he's been a great chief executive for RBS, and he's turned it back to a profitable bank. So obviously seeing him leave is a problem for shareholders. But so we also have this one here. This one is in my lifetime ISA, ACRX. This, I don't want to say it was a mistake, but this is what I want to talk to you about now. Is I got away from what I originally did investing. When I first began investing, I wanted to buy stable companies, low debt, making profits, with growing revenues, like Warren Buffett said, and I started doing that. A lot of the companies I did before, I've done that, but ACRX, I saw it, and I believe in the drug they're making. They have a contract with the Department of Justice, Department of Defense, in the United States, and I believe it's only a matter of time until the army begins to take this on, and then there will be a growth in revenue. However, some of the stuff they're doing recently, I've just made an analysis video on this stock if you want to learn a little bit more, by the way. I'll link that up in the top corner. But some of the stuff they're doing now, like they want to get 100 million more shares into the treasury, which they can release if they have to. People are saying it's being done to prevent a hostile takeover or any of that sort of thing. But I don't know. I'm not super happy with this position that I entered. I'm going to hold it still because I don't want to take a 17% loss. I do believe this company does have potential to go up, and it still has analyst targets of about $8, which is way more than the current $2.96. But what I want to tell you guys is I'm going to try and stay away now. I'm going to try and go back to what I started investing, like how I started investing, which was, obviously, like I said, profitable companies that are making money, growing revenues, stable balance sheets, those sort of companies with a discount and a margin of safety, those are the companies you want to be investing in. You don't want to be investing in these are lottery tickets. I see these sort of stocks as lottery tickets. So if this drug goes really well, this stock could shoot up, but then if they have huge problems, they start diluting the shares, they take on too much debt, this could fall apart, this stock. And I see this a lot at the moment, a lot of IPOs like Uber, Lyft, many more IPOs that are currently happening that are getting valued at around 50 billion. Like Tesla is valued at, last time I checked, I think it might be a little bit less now due to the recent stock crash, but it was around 40 billion, which was more than Ford, the Daimler, which is Mercedes. It was more than General Motors. And these are companies that are earning profits, paying dividends. I know there's the future expectations for Tesla, but I do believe a lot of these companies are getting overvalued just on hype. Let's have a look at the next stock then. I'll have said my piece on that. So this is Countryside Properties. And again, I'm happy to hold this one. This one is undervalued, I think. It's got a super low PE, low debt, great growing earnings. Their dividend is growing every year as well. I believe their dividend grew about 24% last year, which is huge. They are on for growing earnings again this year. I'm going to hold this one. I'm not worried about short term. This is a long-term hold. This is a long-term position that I've got. So being 4% down in the short term, and that some of that is due to fees as well. I lost about 2% straight away from fees on this thing. So I'm actually probably only about 2% down, but it's frustrating, but it is what it is, and I couldn't buy this stock on free trade. It was not on free trade, and the same with ACRX. They were only on Hargreaves Lansdown, so that's why I initiated these two positions on free trade, and that is why I'm keeping my lifetime ISA as well, so I can keep initiating these trades. But obviously you can see here I have quite a healthy amount of cash in this portfolio as well, in the lifetime ISA and the stocks and shares ISA. So I'm going to be looking for some of those stocks again. I'm sort of reconfiguring my portfolio at the moment. You'll see that again in my closed positions in a little while. But we'll have a look at the free trade quickly. And these two were done just to test free trade. I wanted to look at buying international equities such as US equities. I wanted to look at buying UK equity, so I bought Legal & General and I bought Intel because Intel had crashed down to 15%, and I still liked Intel, although I didn't do my due diligence on that, I'll be honest. That's why I didn't realise Intel were getting out of the 5G market and were selling to Broadcom, but again, that is what that is, and I've only got, £70 value in there, so that was sort of more of a test stock, and I do like Intel though. Intel do have low debt, they are a profitable company, they pay a dividend that is well covered. I don't believe Intel is a terrible investment at all, but I'm just going to hold that. That was just a test, and the same with Legal & General. The same with Legal & General is still undervalued, I believe, as well, with the amount of money they make and the dividend they pay. I think they have something crazy like a 7% yield, which we'll have a look at in a second. So if we have a look at the closed positions, I recently sold Aurora Cannabis, which is the ticker ACB. I did this because I wanted to get out of those companies that were speculative, and one of the founders of ACB has also recently sold some of his stock in the company, but he sold it for, a while ago, but he sold it for under what the stock is currently trading at, and that made me feel like at that time the founder thought it was trading at a fair value to sell his stock then, quite an amount of it. And I've heard they're taking on a lot of debt. Their revenue is growing faster than expected, but they are taking on a lot of debt to achieve this, and they are diluting the shares. So I thought I was at I was actually at a higher gain than this before I had to pay these £60 fees, which have already been accounted for in the profit. So obviously my profit would have been way higher if I didn't have to pay these £60 fees, because I had to pay £13 in and out of the stock. I had to pay FX charges, which were about £18, I believe, yesterday to get out of the stock. So it all really does add up, and you can see how much that was cost me overall. This would have been a much higher gain, around 15% gain, if I hadn't had to pay these £60 fees. And this is why you see stuff like free trade coming out and trying to disrupt the market, because it is a lot of money. You can lose a lot of money, especially, and this wasn't even a small position. I initiated a £1,500 position, and to lose a few percent on that is annoying. You can see why someone who invests less money per stock does get hit hard with commissions. And this was a fund that I had. I've had this one since about, I believe it was November time. I've had this since the start of November, and it made a nearly 13% gain, and there was no fees to enter or exit this one. Obviously there were a few fees to hold it, but it was only pence per month, and I couldn't track that individually as it all comes out as one when I had the other ones. But so it would have been probably a couple of pounds off I've paid in fees, but a profit of £127 I was quite happy with that in a few months. And this free trade, this Aurora Cannabis, I only had that since February to March. So you can see that is quite a good gain. That is £187 profit, 12.5%. So this is why some people do invest in these speculative companies, because they do offer great gains. But I don't know, I'm just trying to get back to basics, back to what I would like to do with these stocks, with my investing, and especially with all these trade tensions as well. I want to get more diversified, and that's why I think free trade is a great place to put money as well. It's because it doesn't have as many stocks as Hargreaves Lansdown, which is frustrating, but because there are no fees or £1 per trade fees for instant trades, it does make it possible to diversify a lot easier. Whereas at Hargreaves Lansdown, you need at least sort of £1,000 per position to not get absolutely hammered with fees. Which again, you obviously need a lot of money if you're going to have 20 positions. That's £20,000, which a lot of people don't have currently. Which I'm working towards. We'll get there, but not quite yet. But so have a look at the dividends quickly of what I've been paid so far and what I'm expecting. So this is my graph, and obviously April was a very good month because I got paid from an income fund and the Royal Bank of Scotland. So I made £85 in April. I'm expecting to get paid 41p from Intel next month. Countryside Properties has announced their dividend for July, which is £18.24. Intel again in September. Legal & General in September. RBS again in October, which is £10.78. And then Intel again in December, which is another 41p. So you can see on this graph, there's not a lot of money in dividends coming in, but it totals £115 for the year, which isn't bad. Not £115 isn't bad, most of that coming from RBS. I do obviously need to try and get these more split up, so I do have something in January, February, March. I've got nothing in May, I've got nothing in August, and nothing in November. In 2020 I probably will have stuff in January because I will be in the ex-dividend days for some of these stocks. There you go. Let's have a look at this. So we've seen some of the dividends now, and this is where it gets to the current investment. So this realized profit is from selling these closed positions here. So the AXA Framlington Class L fund and the Royal Cannabis has got me a realised profit of £315. The total gain including dividends, and this is including dividends for the whole year, so you can't really count this yet currently because that's assuming that I hold these positions all the way to the end of through the ex-dividend dates and get paid all the dividends throughout the year, which I am planning to do currently, but you never know what's going to happen. So this will be, if I only make this currently, if I don't make any more money this year plus the dividends I should get that's been announced. So a £315 profit I don't think is too bad. It could be a lot better, but obviously these positions at the moment, they're quite irritating. I am still, obviously like I said earlier, I'm still quite confident in these two. I'm still going to hold them. ACRX is, you can see represented in the amount of value that I put into this stock compared to the others. I didn't have a lot of faith in ACRX anyway. Like I said, I see it as more of a lottery ticket sort of stock. You shouldn't really be investing in. That's not investing. That's getting bordering on gambling. But some people like them. I'm going to try and go back to basics of, again, investing in profit-making companies. So I hope you enjoyed this video with a few books, some Reddits that I like, and a quick look over my portfolio again. I hope I taught you some lessons that you will have learned some lessons from this video, from my mistakes of investing in companies that are not profit-making, although I did make nearly 15% without fees on Aurora Cannabis, so I can't complain too much on that in a few months. But yeah, I'll let you know once I've spent some of this money, once I've invested some of this money, because obviously that is about £3,000 there in cash in the portfolio, so that does need to be allocated somewhere. Also, I don't want to just keep it in cash because the interest I get is like 14p a month, which is catastrophically terrible. But yeah, so I'll update you on this portfolio once I've added some new positions. Make sure you subscribe if you haven't subscribed already. Please subscribe. I really appreciate it. I'm trying to get to 200 subscribers soon. I'm around nearly 150 now. So I really want to get to there. I'd really appreciate it if you could subscribe. I hope I have some interesting videos coming out the rest of the week for you. And I hope to see you in the next one. Thank you very much for watching. Make sure you subscribe, comment down below, and like the video if you liked it. See you in the next one. Bye bye.